with Rishi Sunak calling for an election on 4th of July, and hence a rather optimistic result of projected utter devastation for his party. The major political parties have been releasing their policies, especially economic ones. One such party is the Green Party of England and Wales, who are so left-wing they make Keir Starmer, the so-called moderate of the Labour Party, look like Mussolini. Rent controls, phasing out nuclear power, nationalising railways, stopping all new fossil fuel projects, and banning domestic flights for journeys that take less than 3 hours by train. The whole shebang. They're even trying a more realistic strategy of electing Green Party candidates with the hopes that this will scare the Labour Party to be bolder and tougher, particularly on net zero policies. Hopefully it isn't those same 4 Green Party candidates who have been replaced after antisemitic or extreme comments. Wait, what? Anyways, while these are all very progressive policies that would be interesting to do a deep dive in, one that caught my eye was something called a wealth tax. A wealth tax is a tax on assets like, say, property, pension plans, and jewelry, things that have huge value. This proposal will place a 1% tax on wealth of £10 million and a 2% tax on wealth worth more than £1 billion. There's not much information on it so far, but according to the Green Party, it will raise £15 billion and affect less than 1% of UK households. But there's just one problem. It sucks. Wealth taxes are notoriously bad, especially in Europe. The number of wealth taxes has fallen, as back in 1990, there were 12 OECD countries who used them, but in 2020, only 3 OECD countries, Norway, Spain, and Switzerland still levy wealth taxes. So what happened? Well, a number of things. When looking over a 50-year period starting from the mid-1960s, most countries with a wealth tax saw their revenues remain stable or decline over time. But this is pretty weird, since some studies have demonstrated that household net wealth has risen considerably, yet this somehow didn't translate to higher wealth tax revenues. The remaining wealth taxes usually account for both a small portion of tax revenues and GDP, like around 0.5% or 1.1% of total taxation, with net wealth taxes being the least common form of taxation within the OECD. Switzerland seems to be the most successful in generating wealth tax revenues, with 3.9% of their revenues coming from the wealth tax. This statistic might give warm comfort to the Green Party, and while yes, Switzerland has a relatively low tax exemption threshold, and a high percent of overall tax revenues from wealth taxes, they don't levy capital gains taxes, and most Swedish cantons have abolished inheritance and gift taxes. So the wealthy are probably more willing to pay wealth taxes since they may act as a substitute for capital, inheritance, and gift taxes. So why did these wealth taxes fail? 2 words: tax exemptions. When it came to their wealth tax, there were a ton of these in these policies. You see, if you try to tax every type of asset, you run into problems. For instance, there could be liquidity issues, as people with illiquid assets like houses could be forced to sell them to pay the tax in the first place. If you have a job, you can earn liquid cash from that, cash that you can easily pay tax on. The market value of your labor is the liquid cash it generates. The laborer can easily use this liquid cash to pay income tax. While wealth also has a market value, unless you sell it, you can't have that market value as liquid money. So you can't directly use that market value from the asset to pay the tax. Therefore, a wealth tax isn't necessarily based on your ability to pay, unlike the income tax. So if you have a salary of £30,000 but an asset worth £3 million, and you have to pay a 1% tax on it, you will need to pay your entire salary just for that tax. This is of course an extreme example, but you can see the problem. A high tax threshold might solve this, but even then, people whose wealth is tied to a private business would still have liquidity problems. With such issues, clearly taxing other assets could hurt people who may not be able to pay the tax, such as taxing pension assets, since pensioners usually can't work anymore. Hence, these tax exemptions include pension assets, primary residences, business investment, artwork, jewelry, and antiques. These exemptions aren't exactly unjustified. The obvious problem is that more exemptions reduce tax revenue, but that ain't the half of it. This large number of exemptions means preferential tax rules, which increases the complexity of the wealth tax system, leading to high administrative costs for the government and high compliance costs for taxpayers. With such high costs, the tax may not be financially feasible. And to add insult to injury, these exemptions were applied on assets that are mostly held by the wealthiest of taxpayers, so it was quite regressive. maybe communists should eat the wealth tax instead of the rich. The rich were also able to easily evade these taxes by having their wealth overshores. For instance, you can simply just not report foreign income or assets if domestic tax authorities can't access that information. And factors like increasing capital mobility and tax havens don't help, with the top 0.01% of the wealth distribution owning roughly half of the wealth in tax havens. This same group also evades 25% of their income via hiding foreign assets and investments. Finally, and this is a kicker, but there were valuation problems. It was hard to know the true value of wealth. You see, if you sell an asset, you can get the market value in cash. This transaction is based on an agreement between a buyer and a seller, who have both taken into account the various opportunity costs of not using their money to buy another product instead or to find a different buyer. But what if the asset is not sold, where you don't have any liquid cash to show for it? Then it will be hard to determine the actual market value for the wealth, since the value is subjective. This part may be hard for me to explain, so feel free to ask me to clarify this part in the comment section. Sellers and buyers within a market transaction are the best people to determine it, as the market system is able to rapidly take into account thousands, if not millions of variables, since the entire economy is connected. Prices of one product or resource can affect prices of another product or resource. So prices or market value takes these other prices into account when in a transaction. Prices show the opportunity costs of the goods you want to buy, but when the government tries to value such assets, they are unable to take into account this information, since it will be hard for them to put themselves in the shoes of these buyers and sellers on an individual basis. They won't be able to analyze the millions of variables/prices that can properly provide an appropriate value. Basically, you can't easily assess the market value of wealth without it being in a transaction. To make matters worse, regularly updating asset values increases the cost of tax compliance and administration further. This justified exempting some of these types of wealth as well, but then again, that also helps expand more of the tax avoidance we mentioned before, so that's even less revenue. Maybe these valuation problems could be solved, such as insurance values for jewelry, book value for businesses, and threshold exemptions, but even with these, there are still drawbacks like property assets, which tend to be overvalued, and intangible assets may still be a problem. Just before I move on, if you like this video so far, feel free to give a like and comment to help the video in the YouTube algorithm, as well as subscribe to see similar content on my channel. Now, as you may recall, the Green Party claimed that the tax will raise £15 billion. A wealth expert from the University of Warwick claims that raising this much was credible but depended on the design, while the Institute of Fiscal Studies say that while a wealth tax could generate revenue, it would be tough to implement. Now, I am personally skeptical of this £15 million figure. It is hard to think that this tax on 1% of wealth above £10 million can generate £15 billion when the French tax has one of the highest tax exemption thresholds at €1.3 million or £1.14 million, with a rate ranging from 0.5% to 1.5%, but had generated only €5.22 billion in revenue. To put this into context, this was just €15,200 per wealth tax paying household. Not to mention that Spain had a 1.7% tax on a threshold of €3 million of wealth and going up to 3.5% for €10.7 million, yet only raised €632 million, which may be a much similar tax to the Green Party. The threshold for the French tax is about 10 times less than the Greens, while Spain is 3 times less, yet they generated nowhere near the £15 billion amount that the Greens won, even when accounting for currency conversion and national GDP. If you think this tax will raise even close to what the Green Party suggests, then you are more high than Joe Biden when he said poor kids were just as bright as white kids. At least I hope he was high when he said that, just like his son Hunter Biden. Now, some would say these exemption concerns are unfounded because the threshold is set much higher than the European ones at £10 million. For everyone confused by this, let me explain. One of the reasons for a massive move to implement exemptions to the wealth tax was that it affected ordinary people. This was because of the low tax threshold reaching people with lower wealth. This created the fuel to create numerous tax exemptions which hurt tax revenues. With a much higher tax threshold, there would be less of a need to exempt wealth, and hence there would be much less tax exemptions. But as I said before, there are still assets that inevitably need to be exempted, like pensions and businesses, regardless of wealth, and that certain types of wealth are too costly to value. Also, without these exemptions, it increases the probability of the wealthy leaving. Besides, the general trend is countries that adopt wealth taxes gradually increase exemptions and reliefs, which suggests that tax exemptions may be inevitable anyways. Now, maybe you could argue that international tax transparency has improved thanks to stuff like the exchange of information on request and the automatic exchange of information, but the latter led to nearly 100 countries exchanging information in 2019 for data on 84 million financial accounts with assets of 10 trillion euros. But this at best only might solve the evasion problem. We still have valuation constraints and most likely high levels of exemptions for the British wealth tax. So overall, the Green Party's wealth tax will have a myriad of problems that could be numerous exemptions, tax evasion, liquidity issues, valuation difficulties, less than projected revenue, administrative costs, and tax compliance costs. Even if the wealth tax didn't have all these problems, apparently the borrowing cost will still be £80 billion higher when looking at the manifesto. I'm just glad they're not going to win this election. I'm not sure if I'll be able to make another video on the UK election before election day, but we'll see. I am like halfway through some scripts like a video analysing divorce and celibacy, excess profit taxes, and whether corporate greed has caused all of this inflation. A ton of great stuff. So if you want to see more of this, then please consider subscribing. And again, please give a like to help my video. Thanks for watching and see you later. Bye.